Hey traders, this is Ron Haight. Happy Sunday. Hope you guys are doing great. As always, everything in this presentation is for educational purposes only. All right, this is Thinkorswim on my screen. We're going to start with the S&P 500 ETF, the Spiders. Finished pretty much at 300 bucks on the nose on Friday. Again, daily chart, the red line is a 20-day exponential moving average. That is a nice trend trading moving line. Represents about 1 month's worth of price data. The big one that we want to keep an eye on here is the institutional line. That is the 50-day SMA. It's a simple moving average. When stocks are above it, they're viewed as institutionally bullish. When they're below, well, they're not. They're now bearish. We are coming in to that 50-day. We're within probably about a buck or so of actually nailing it. We want to close below, not an intraday move, but a close. The last time we got down near it, we bounced and we closed the highs of the day. If we then break it, it's going to show a change in investor sentiment at this point. So that is going to be the motto for this week. Watch the 50-day. We get below it, the bear is going to get a technical edge on the daily charts. Let's take a look at the diamonds, DIA. Now they were down and they actually hit the 50-day. They barely closed above it. Who knows what the futures are going to open up with tonight? As I do this video, it's almost 4 p.m. Eastern. We could gap down, we could gap up. Who knows what's going to happen until the Monday morning open at 9:30 a.m. Eastern in New York. If we get below the 50-day tomorrow, Monday on an end-day basis, that is going to be technically bearish. Once we got above it on the Dow, back on 427, we hit it once, twice, 3, 4 times. We never really got too close to it here back about 2 weeks ago, and now we're on it. We're still putting in these lower highs. Very interesting. We break that 50-day, there's a little bit of unfilled support here at the gap, and then we go back to this swing low. If that low can't hold, gap fill, this area is support, and then all the way down here. I think things could unravel here pretty quickly if that happens. Here are the Qs, incredibly strong. They were down almost 2.5% on Friday. They are essentially right on their 20-day EMA. Looks like the 20 days 240.18. We finished at what, 240.22. This is pennies on a $200 stock. So we're basically on it. If we get below it, that's going to be the first time, get this, since the Qs closed below it over here. Once we got above on April 6th, it's been no looking back. We may have touched it, but we bounced every single time. That will also show us a change in sentiment. However, the 50-day is still the big one. So I get a lot of questions on where would hedging come into place? And there's no perfect answer for everyone. But if we use the Qs here as an educational example, if we get below the red line, if I was trading the Qs, maybe I would start considering covered calls on my stock, maybe up near here 250, right at the previous high, the all-time high, the resistance area. If we break the 50-day, that's when long puts would come in to protect the position. Because if you look over here, once we broke the 50-day, we tried to rally the next day, was rejected, we fell down, got back up, hit it again, and then the plunge occurred. There's no guarantee that's going to happen again, but those are the signs we want to watch for. Now, if I wanted to take even a less risky position, if you will, the moment we start getting below the red line, I can start thinking about collar trades or adding puts already. But just based on how many times it's bounced as support, we break it, that's the first sign of trouble. It's really, to me, about that 50-day. That's where I'd want to get more hedged. Again, as an educational example. Now let's do a weekly chart just to compare. This is on the weekly. Now this red line is a 20-period weekly, and this is a 50-period weekly. This is incredibly strong. Is that potentially a reversal candle? Sure, but so was the one 2 weeks ago, and we still ended up closing higher the week before. We got to get all the way below this red line for a sign of trouble. Therefore, when the weeklies are so far disconnected from the dailies, meaning the weeklies are just so bullish, there's nothing here to even, we'd have to drop a huge amount, over 10% to even get below that red line. I would then go back to the daily and say, okay, I need to watch the red on the daily and the orange on the daily. Those are the two signs. The weekly is going to be too far away to help me make a maybe more informed decision. If I go to, let's do the Dow, do a weekly. The Dow's a different story. The Qs are so bullish, the Dow is not. The Dow punched through 4 weeks ago. Then we had the immediate reversal candle, a big candle. These big opposing candles are warning signs. They're not huge. They're not like island reversal patterns or major hammers or something like that, or bearish engulfing. They're still important, just lower on the scale. Now we're pushing lower. This was a huge battle. We went up, the bears came right back in, sort of punch the bulls in the mouth, send them running, boom, right back. And what's happening? We're now pushing lower. The weeklies, I would say on the Dow now, are actually bearish. Weeklies are more bearish. If we go to a daily chart of the Dow, all right, we went up, we came down, we're still above the 50-day. All we need is one down day on a daily chart of the Dow, and this is going to also coincide with what the weeklies are telling us. So weeklies already bearish, dailies 1 day away from pulling it off. If we go to the spiders, let's go back to a weekly. We zoom in. Here was the big move higher. There was the big reversal week. And the reversal week happened on bigger volume. That's another just warning sign. But we're still holding above the moving averages. So the Dow's the weakest. The SPY is in the second position, and the Qs are still wildly bullish. If the SPY can close below both these moving averages, the 50 period in orange and the 20 period in red, that'll confirm a sell signal on the weeklies. But we have to get through this entire week. And if we go to the dailies on the SPY, the dailies will crack first. So if we get, let's say Monday's a bad day and we get down below the orange, that'll be the first sign of trouble. But just so you know, the weeklies need the whole week to take place before they would confirm. The Dow right now is the most bearish. When it gets below the 50-day, the daily will be on a sell. And just saying it one more time, the weekly's already there. So if I had to pick which of the three to be bearish on, if things start getting, bad on Monday or Tuesday, the Dow is leading the charge lower of the big three. Sorry for that long analysis, but I do get asked quite a bit, how do you compare dailies and weeklies? And I hope this was helpful doing that type of analysis. I wouldn't want to be bearish on the Qs. I guess I could be if I wanted to be more aggressive, but the one that looks the best clearly is the Dow. Okay, to me. All right, let's do some other stocks here. Let's take a look at XLF. The XLF, which is the banking ETF, broke the 50-day on Friday. Rise in volume. This is not good for the broad market either. If the banks can't come along, the markets are going to have some trouble. Here's Goldman, big volume. They closed below their 50-day moving average. They're next. There's a little bit of a gap here, but I would say it's sort of a support range. We could go down to maybe 170, up into that 180. It's almost like a $10 support range. Bottom line, though, Goldman broke down on Friday. Bank of Corrupt America, as I like to call them, BAC, closed below the 50-day in orange. A little bit of an unfilled gap here. They're pretty much there. I would say the bigger support is down here where that bullish engulfing is 21-ish. We take a look at JP Morgan. They also closed below the 50-day, 2 out of 3 days, which is interesting. We tried to rally back up and hit the 20-day, and then we just, boom, go right back down. Gap support 90, but really probably down here towards 82 are the downside targets. None of these banks look good right now. Here as well as Fargo. What have we done bad to our customers lately? Now, interestingly enough on this could be a left shoulder, this could be a head, and this could be what's forming to be the right shoulder. This could be an inverted head and shoulders pattern. The problem is, if you will, we would need to get above 34 bucks for that to break out. I mean, holy crap, the stock's at 25. We're talking about nearly a 50% rise before the pattern would actually look very bullish. So I don't like Wells Fargo here for lots of reasons, but head and shoulders above 34. Right now, you'd be going down to the lows at 22 would be the target. If we take a look at Marriott, had a question on some of the hotel stocks. The states won't open. We can get into this debate whether this, that, and the other thing about the virus. But without the states allowing these folks, these hotels to stay open, the amount of cleanliness controls, if you will, let's not get into the good and the bad and all that. All I'm saying is, this is at a cost. It's going to keep people away, potentially, yada, yada, yada. Plus, beaches may be being closed. All these things are bad, no matter what maybe our personal views on the virus. It's just bad for these types of stocks. And Marriott now 3 straight days below its 50-day. A little bit of potential support here where this bearish engulfing is, but really, I hate to say this, but it's almost the downside target is a 50% drop in share value. It's literally down to these lows potentially. Will it get there? I have no idea. No one's going to know. But initially here, and then, oh dear, that rhymes. How about Hilton? Same thing. 3 days, actually 4 days below its 50-day. Maybe support here at bullish engulfing. Then here, and then, oh dear, down there. Again, heavy volume on Friday. Here is Hyatt. 4 days below, 5 out of 6 below its 50-day. Support here, 10% lower. then here, and then down here. They're all looking bearish. We'll have to see how this is going to play out. And remember, when this comes back in the fall and it mutates, it's going to be a new strand. So why things are opening up and it's putting tax revenue dollars back in the economy and local governments, if they lock it down again in the fall, these things are just going to get worse. These stocks are going to get worse. Here's Johnson & Johnson down about 1.3%. Once we had this big down day here back on 6/11, we tried to rally, could not get above the 20-day in red. Interesting. Johnson & Johnson sometimes trends really, really well using the 20-day EMA. And now we're starting to drop 3 straight days below the previous closing low. There's a little bit of an unfilled gap at 134. And then you're talking about 109, which were the March lows, 30% lower. And Disney is seasonally bearish over the summer. It's an amazingly seasonal type stock. The big money typically flows out. Now, it's not a horrible downtrend over the summer, but it usually doesn't do well. So think of it this way. You have the COVID, you have Florida not wanting to completely open Disney, have all these rules in place, local governments doesn't want to allow them to open, etc. They're going to try to open this and that, but not everything. You have that going for normally a time when money comes out of Disney over the summer. It's going to be really difficult for this stock, in my opinion, to really rally unless there's a change that's going to be fundamentally different. So what I would watch for is here. If Disney bucks the trend, watch for something above the 50-day and the 20-day. We get back above both, then I would go maybe the 20-day stop, end of day stop. But traditionally, this thing drifts lower now through October. I had a question on Dropbox, DBX. It had 3 big down days. Volume, I mean, even though the volume is only what? It was at 8 million, 7, 8, 9, 10 million shares, a decent amount of volume. It's not huge volume, all things considered. Last time we broke the 50-day was over here on 6/11, and then it jumped right up. Now we have 3 straight down days. Because the 50-day hasn't worked, maybe what we could do is consider trying a different moving average, a 55, a 60, something like that. If that doesn't work, then I would go back to the 50 and say, hey, we're below it. That advises some caution, I think. If I zoom out here, let me just grab max. So we're coming back here. Here we stand. This is apparent. It's actually like a triple top. Look at this. Here's a high, here's a high, and here's a high. Each time you got rejected. But here's what the bulls have going for them. Here's a low, and so far we have a higher low. As we're getting up here and digesting that overhead supply, it failed. Then we go right back up and it failed. But if these higher lows keep coming in and it breaks through there, we start cutting through that area, then you start jumping up to 26. There's a bit of a double top, and the next major area of overhead supply is going to be in the 30s. So right now in the daily chart for Dropbox, it is technically bearish because you're below the 50-day. If the 20-day in red crosses down through the 50, that will give a technical sell signal. That would also be bad for Dropbox. And last but not least, I want to just show you the tale of 2 stocks here on mining stocks, ETF versus an individual. Here's Newmont Mining. The stock broke below the 20-day, hits the 50, plays a little bit of ping pong. Ooh, look at that. It actually does bearish engulfing. And then we drift lower, then we try to bounce and we can't. Another bearish engulfing, and now we're trying to bounce and we can't. For whatever reason, look at that 50-day. And whoever's trading the stock apparently is paying attention to this big time. It even acted over here once we got above it before the launch. Bounce, 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 break. Hit your head, hit your head, hit your head. All week last week, we couldn't get above it. So that tells me that Newmont above the 50-day would be bullish, technically, target 69. If it gets below the 20-day, it's not the end of the world, but you'd want to watch this area here. It looks like 54 bucks is maybe a decent support level. Below 54, then you come back down here. So basically, this stock would be a no-go from a bullish perspective until it gets above the 50-day, the way I would teach it from an educational perspective. How about GDX? The mother hen. GDX is above its moving averages. This is actually doing a little bit of a bull flag. It's a mini, but it popped and now it's just back. It's testing the top side or back testing the 50-day. Tale of 2 different stocks here. GDX is in a much more bullish position versus Newmont is not. Newmont needs to get above the 50 and GDX already is. Now, if GDX were to roll over, on Monday, Tuesday, whatever, we get below the 50, then it goes to a sell signal, and then watch these lows around 32, 31 and a half, 32, because then you start talking about maybe something down in the 20s for support. So that is it. Wish you guys a fantastic week ahead. It is the week of July 4th, so it's going to be a holiday shortened trading week with the markets closed on the 3rd. So it's 4 straight days. I'll be with you probably Tuesday with a video, and that might be it for the week since the markets are going to be closed Friday. If the market goes bonkers on Monday, I'll do a video with you Monday, and then we'll probably skip to Wednesday. So I'm going to try to do every other day unless we get nuts, and then I'll be back with you every day. So again, take good care, gang. Hope it helps, and I'll see you in the next video.